Alrighty, folks, we finally got what I thought was the tough, big-chested Paul Volcker, Jerome Powell, where he's talking tough, trying to get the market to stop having 4 cuts in 2024. He's threatening more rate increases. He's saying a soft landing is not his base case, that he may have to force a recession. Lots and lots of scary stuff. Rates are going up. Mortgage rates in the residential space are now over 8% with 10% down in a 750 credit score. Oh my goodness. But we're going to talk about the commercial market because it was in trouble before, and this won't make it any better. So we're going to talk to the one and only Jonathan Twombly and help paint a picture of how foreclosures have started and try to give you a feel for the timeline and how the dominoes fall in this very unique asset class. So, Jonathan, what's going on?
Well, I'm back from being away for a few days and trying to get my head back into doing stuff again. So
Exactly.
It's never easy, but still fighting the fight, raising money for my hotel deal, which, by the way, if you guys are interested, I have a few spots that have opened up because we're raising a little bit more money. So just sent out a really great investor update on that a few minutes ago. So, if you're interested, please let me know. But it's actually great. I'm sorry, I don't mean to sidetrack the conversation, but I'm just really excited because I just saw a competing hotel go on sale in the market for basically $16,000 more per room than our all-in cost on this hotel. Like basically when we do the renovation, we'll spend $16,000. So basically getting 30% like built-in equity on the deal. So it's really great. So anyway, foreclosures in the multifamily business. What would you like to know about that?
Well, I think we need to paint a picture because I think a lot of people probably think residential foreclosure process, right? You don't pay, 90-day notice, then you file an NOD and, it takes a while to get out. I think my experience with multifamily foreclosures, because again, they did happen last time and I bought a couple, they actually take longer because typically the operator can kind of, hang on a little bit longer because there's a little bit more rent collection. You can rob Peter to pay Paul, and there's all of this, but the stress is clearly rising, and the end result's going to be plenty of foreclosures, I think.
Yeah, I mean, I think that this is the multifamily market is less liquid than the single family market, right? So lenders are reluctant to take these assets back. Right there, it's as bad as if you put yourself in the shoes of a lender, like as they don't want to be in the business of holding on to single family homes because they got to do maintenance, but that's all they got to do. They just, they got to mow the lawn, they got to keep the utilities paid, they got to make sure the place doesn't deteriorate, but they don't really have to do that much. Think about a multifamily property. You've got 200 tenants that you have to manage. You've got to collect rents, like you've got to do all this work. Maybe they're going to keep the management company on site, but if the ownership group that they're foreclosing on is also the self-managing, then they've got to replace. Not only do they have to bring in a receiver to run the show, but they've got to bring in a management company. I mean, it is a big problem. So they really don't want to do this if they can help. If they can help it, and so that kind of gives the owner a little bit more levers to pull to try to forestall foreclosure. Like, hey, we're going to fix it. Probably the first discussions are like, hey, this is the plan to right the ship, right? See how that goes. Give us some forbearance, try to rewrite the note, right? And it's not going to happen quite as quickly as with a single family thing. Although, sometimes you may just get people handing the keys back, right? Saying, hey, don't foreclose, just take it.
Here you go.
Here you go. So your problem now, right?
Yeah.
So, that can happen too, or there might be a deed in lieu of foreclosure. But if the sponsor wants to fight it, they've got more ability to kind of fight it. Plus, they're probably going to they may go to court, right? They're going to lawyer up. It's not the same situation as like an underwater single family homeowner who's just like, what the hell with it, take it. So
when I look at the multifamily space and what's going on, and a lot of the debt that was underwritten was non-recourse debt. Obviously, there's some,
Right.
clauses that can make that, but most of these operators are like, dude, no skin off my back. Here you go, mail the keys. I'm out. I'll go do health. I'll go do something else. To be a scumbag raise to steal money from people or whatever it is. But this is going to be a problem. And again, I think the Fed told us over a year ago that he was coming for this area and rates were going up, and the market didn't believe him. I mean, Barry Stern, like right, Billionaire Barry, I joke about all the time. He closed a mortgage company, BK, bankrupt. He stopped distributions. He sold his homes to raise cash. And now, if I think about a month ago, he talked about doing a distressed fund. So again, they're all just pivoting to these new things. So um, I I think we're still way early in this, right? I
Yeah.
know we've heard about high profile stuff, but I'm getting more and more phone calls and notes from people like Michael. You have no idea how bad it is.
Oh, listen, we've just seen the tip of the iceberg so far,
Right.
right? I mean, we just have, this is going to be like a rolling disaster for some time. And I think, what happened is just too many people bought the hype about multifamily being such a stable asset. About they looked at 20% rent growth in 2021 and 2022 and decided this is going to last forever. Can't lose proposition, and they just really kind of turned a blind eye to what could go wrong. There's a whole bunch of things that could, not just interest rate increases, but I mean the economy could soften at any time, right? I mean, there's things like that, but usually in multifamily, what I found is that there's always some story that people tell to avoid dealing with reality. So they say things like, "Well, in a recession, more people will rent," right? Which is not true, right? That's based on the data point of after the Great Recession,
Yeah.
after the recession was over, 2 years later, we had the foreclosure crisis, and all those people who got foreclosed on then went and rented, right?
Right.
It's not what happens in a recession, or even in the Great Recession. It didn't happen that way, right? This is a complete myth that people made up to avoid thinking about, well, what happens if there's a recession? And the interest rate thing too, I remember back in 2019 saying, well, what happens if interest rates go up? And it had all these people jumping on me, some people very prominent people in the multifamily industry who have raised millions and millions and millions of dollars, jumping on me viciously saying, cap rates have nothing to do with interest rates. Like in the 1970s, when interest rates went up, cap rates didn't go up by as much, and blah 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 blah, right? And all this kind of stuff. And I was just kept saying, but I don't see how the math works. If interest rates go up, how does the math work? And they'll go, well, people will put up more equity. I'm like, yeah, but then the return. This is just not like you guys are. Yeah, that in theory that's true, but where are you going to get the equity from? Especially if interest rates are going up, and people are then just, oh, I'm just going to put it in the bank.
Put it in the bank. Why? Yeah, exactly.
Yeah. So you're just going to be able to, but dry powder. What's the dry powder? The dry powder is all there waiting for bargains. They're waiting for foreclosures. They're not waiting for 5 or 10% discounts, right? So but there's always a story. And this is one of the things I think as an investor, you have to really just really think seriously about. Like, you have to think about the downside. You have to think about how you protect yourself. You have to, when you say you're underwriting conservatively, that actually has to mean something. It doesn't have to, and sometimes what that means is you don't do deals, right? Because the deals don't work. And it's not because, you're not getting enough cash flow or whatever. It's because the math doesn't work and the risk is too high, right? Yeah. And a lot of people just ignored that. And this happens in every cycle. We saw it before the Great Recession with single family houses. We see it now with multifamily. And now, the price is going to be paid, right? So, but
yeah, I think there's going to be a couple of things that if I were to make a wild guess about the next year to 18 months is we're going to see, I don't know, I guess I'll call them the new operators. We're going to see, because what's happening every day now is the stress is ratcheting up. They're under more stress today than they were yesterday, and they'll be under more stress tomorrow than today. At some point, and I think a lot of them probably this year. So what's that? 90 days left, 100 days left, whatever it is in the year. They're going to mail the keys in and give up, right? They're going to be like, hey, we tried. It didn't work. The debt's non-recourse. Sorry, investors, you lose. And I think they're going to give up. Then on the other side of next year, we're going to start to see the servicers pick winners and losers. They're going to say, hey, you're a good operator. You've got the balance sheet. It's just bad timing. We'll extend and pretend we'll work with you. And then everybody else, they're going to be like, we got to switch horses.
Yeah.
So, I think most of this debt, the $1 trillion or 1.4 trillion that resets in the next 18 months, I think 60 or 65% of that ends up with a new operator minimum. And I think that's where we're going.
Yeah, and I think we're going to start seeing more assets hit the market, right? And
Yeah.
because I think
Out of
what's going to happen.
desperation, you think?
Yeah, no, because
Yeah.
I think a lot of I mean, let's call it calculation, right? I think a lot of sponsors will come to the realization that if they sell, they can get out with some of their investors' equity intact, or they can at least break even on the deal or something, right? Or they can save their own skin by, their investors not having to put in more money, right? So they'll just, I think you're just going to start seeing more sales happening that are not foreclosure sales, but they're sort of pressured sales, right?
Yeah.
And so just because there's really no choice, and the sponsors also don't want a foreclosure on their record, because then it's going to be very difficult. Yeah, it's going to be very difficult for them to borrow in the future if they've got a foreclosure. So they're going to start selling just to kind of save their skin, and that's when we'll finally have some real price discovery in the market. And then I think that's when all the vulture funds and all that dry capital starts to move in, when they start seeing like the 30% discounts off of the prior peak pricing, because usually 30% is about what the market loses, like peak to trough, right? Give or take. And so once they see those discounts, hitting, then they'll start to feel comfortable buying again. And of course, it's going to be the biggest, the deepest pocketed, investors.
Blackstone has got another fund. I think it's like $40 billion or something set aside already. It's crazy.
Right. Who can get the debt, right? Who can get the debt, because the just average Joes are going to have a much harder time getting, the debt for these, especially for these big deals. I think if you're a smaller investor and kind of proportionately, like, you have a good balance sheet for the deal you're doing, you have good credit for the deal you're doing, then you may be able to get some opportunities too. But I think the days are over where like some random person who comes out of a coaching program can go and buy like a $50 million deal by cobbling together like 20 GPs and, and having them all sign on the note, or getting some unrelated guy to sign on the note for them. Like, I think those days are probably done, at least until like the new generation of lenders comes in and they've forgotten all about this, or the greed takes over. But I mean, I just don't see how we're going to have this frenzy return. And frankly, I'll go out there and say, for the record, that, I mean, you and I have discussed many times that there ain't no Fed pivot. I mean, I think at this point people have, people have got to, they're giving up the ghost now finally, because they're realizing interest rates are not coming down. Powell does not want the double dip inflation that they had in the 70s when they reduced rates too quickly, after they thought they killed inflation and then inflation came back. That Powell's not going to let that happen on his watch. That's why he's talking tough. So I think people are finally, this whole like, the rates are coming down next year, I promise, kind of thing, that's all going away. But let's just say that it does happen. Even if that does happen, the banks are not going to be lending to those people again. Right. No, exactly. Like that whole, it happens every cycle. Like the last, used to be able to get, before the great financial crisis, you could get like real true non-recourse debt on multifamily properties. There weren't guarantors and carve outs and all that kind of stuff. Because of what happened during the Great Recession, where people walked away, then the bank said, okay, now we're going to have, even though this is non-recourse, we're going to make it part, it's really not true non-recourse. And now I think what will happen the next time around is the banks are going to look at the people that they lent to and go, I'm not so sure. We're not going to lend to these people at these prices again, unless they have a track record, right? So the
Right.
track record, I think, is going to be the thing that's going to prevent people from getting the debt going forward.
Yeah. I think at the end of the day, the other thing going on behind the scenes is just banks don't want to lend. I mean,
Well,
the QT and the bank reserves and all of those things going on. It's just kind of it's a tsunami of bad,
yeah,
and it's going to prevent not only net new deals but also refis. And if you're kind of semi questionable, it's just it's a lot more forced sales. I think to your point, it's going to be the best option for people is to sell, try to get some of the equity back, try to leave with some is better than none, I guess.
yeah. I mean, I'm actually, the banks are really in a position where they can't lend at the moment because they've got to
Yeah.
rebuild their own balance sheets. I'm actually interviewing a banker this afternoon on my podcast. I'm really
Oh, nice.
excited to talk with him because this is actually a guy who started a bank, which is almost impossible to do these days, but he started a new bank. So
Nice.
I'm really looking forward to interviewing him just to pick his brain about what's going on in the banking world at the moment, what bankers are thinking about. So I can come back and report on this next time.
Awesome. I look forward to it. What is the podcast so people can go look for it?
It is the Apartment Investors Club podcast, as if you couldn't have guessed what
I
it's
just wanted to
called.
make sure. Thanks, Jonathan.
Absolutely.